So as we get into the new year, could we be setting up for conditions where liquidity is tightening, growth is slowing down, valuations are still high, and therefore, how much are you kind of rebalancing your allocations at the moment to prepare for that?
Well, Heidi, you hit the nail on the head. I mean, that is the macro environment that we're going to be in, which is one of slowing growth and rising rates catalyzed by higher inflation. And anytime you've got those conditions, they tend to be less favorable for equities than when you've got, say, growth rising and rates falling. That's pretty obvious, but it's important to note. Against that backdrop, however, we think there's a couple of supporting and offsetting counterbalancing factors. Number one, at least for Asia, valuations actually have come down quite significantly. They peaked earlier this year in February at 18.2 times forward earnings. We're now about 14.5. So we've come down about 20% in terms of forward valuation, which, and based on our forward-looking models, we think that about 14.8 times is fair value for the market into next year. So we think we've sort of had the valuation correction. And then on top of that, we've got very light positioning in terms of foreigners having sold a lot. So the intersection of these two forces suggests to us that markets are likely to trade in line with the underlying earnings growth for next year, which we think will be about 9%. So that sort of 9-10% is about our expected return for the markets. Now, against that much more sort of subdued beta outlook compared to, say, the very robust gains we enjoyed last year, we think the key thing will be to have active alpha tilts on top of that. And the key changes we've made from a market perspective have been to upgrade China and to upgrade parts of ASEAN. And to pay for that, we've downgraded India and we've downgraded Korea. So that's sort of our view in a nutshell.
That regional rotation from taking profits on India and then getting back into China seems pretty popular, increasingly popular when you take a look at valuations. Does that mean you see the risk, the regulatory risk, as having receded adequately in China?
Well, that's a critical question, and I would slightly rephrase it. I'm not trying to play word games, but I think the way we would characterize it is we think that the regulatory tightening, the momentum of that, the pace of that is moderating. So we have a proprietary tool we've developed. It's a text search tool that looks at over 1.5 million different articles in both Mandarin as well as English, and we can calibrate the degree of regulatory tightening in 9 different industries. And the most recent reading of that suggests that we've had sort of a moderation in the pace of regulatory tightening. So it's still high, but it's come off somewhat. And so we think that sort of second derivative, that rate of change, if that continues to moderate, that will be supportive for a market which has already fallen a lot and priced in a fair amount of negative outlook.
What about bond yields continuing to rise? Because we have seen the pressure on the global tech stocks. Will this be a double whammy for Chinese tech stocks given the regulatory crackdown as well?
Well, it could well be. Technically, what we're looking at is the duration of equities. In simple terms, that's basically that the longer or the more growth that one's expecting, the longer the horizon in which you get your cash flows returned, and that just mathematically makes those sorts of stocks more sensitive to changes in interest rates. So broadly, you're absolutely correct that as we see higher U.S. bond yields, we just moved up yesterday to the high 160 level. That's something which starts to exert some pressure on markets. Now, we've baked that into our expectations. We're looking for 2% 10-year bond yields by the end of next year. We put that into the macro models I mentioned a few moments ago, which give us a 14.8 overall expected valuation. But if there's a sudden increase in bond yields, or if indeed bond yields exceed that 2% level that I've mentioned, then that would be putting pressure on the longer duration stocks in Asia, which would include some of the Chinese tech stocks that you mentioned.
Tim, we're seeing Samsung right now rallying for a 4th session. Of course, they're investing again in Texas. How much of your downgrade of Korea is to do with the semiconductor story?
Well, it's about half-half, and it's a well-asked question. I mean, the two obvious aspects to Korea are, number one, that both the economy and the equity market are the most sensitive ones to global growth in the region. So, typically when you're looking at a global cyclical upturn, Korea is the first place you go to on the long side. And when you're looking at a slowdown, Korea tends to be not the most favored market in terms of being somewhat more defensive or more insulated to a global cyclical slowdown. So that's number one. Number two is, of course, that Korea equity market is quite sensitive to the semiconductor cycle, just given the very heavy weightings of Samsung and Hynix, which together account for about 25% of the MSCI Korea index. So we're looking for the semiconductor cycle to turn down, and as indeed it has started to do. We think it will upward inflect sometime in the third quarter of next year. So it's not that we're super bearish, because we think that the stocks have priced in a fair amount of concerning news already, but we think it's probably a little bit too early to get aggressive on them, and so we just prefer to sort of hang in the sidelines and have a neutral weighting, and then maybe look to more actively and positively engage sometime as we go into the first quarter of 2022.